Imagine waking up to a notification that the financial world is whispering about a currency you might hold, a currency that has been the subject of dreams and debates for over a decade. The Iraqi Dinar. For years, the story has been one of waiting, a patient, often frustrating anticipation for a revaluation that promises to change lives. But today, something is different. The whispers have turned into concerned conversations, the quiet analysis has become a series of urgent bulletins, and a palpable, uneasy shift is occurring in the market's atmosphere that has nothing to do with the old, recycled rumors of an imminent RV. This isn't a hype-driven surge of excitement. It's a cold, analytical wave of concern washing over the desks of market strategists and economic forecasters who have been monitoring the dinar's pulse. The mystery move we are seeing isn't a dramatic spike in value. It's a series of subtle, interconnected signals in the underlying infrastructure and geopolitical landscape of Iraq itself that are causing experts to sit up straight and question the very timeline and nature of what they thought was coming. The data we are about to explore points not to a simple revaluation event, but to a much more complex and potentially risky financial transition, one that could leave unprepared investors facing a reality far different from the one they were sold. The core of this concern stems from a critical and often overlooked distinction: the difference between a politically symbolic monetary reform and a genuine, market-driven strengthening of a currency's value. For the past month, a quiet storm has been brewing not on the forex screens where most dinar holders look, but in the dense, technical reports from the Central Bank of Iraq and their ongoing, high-stakes negotiations with the United States Federal Reserve. The CBI has been aggressively implementing a new digital banking platform, a system designed to bring transparency to every single transaction. On the surface, this sounds like a positive, modernizing step. However, when you cross-reference this data with the Fed's own quarterly reports on its foreign currency holdings and liquidity operations, a startling pattern emerges. The volume of physical US dollar cash being shipped to Iraq has seen a measurable, deliberate decrease for 3 consecutive quarters. This is not an accident or a simple budget cut. This is a coordinated policy. The United States is systematically making it more difficult for Iraq to operate on a pure cash dollar system, forcing the Iraqi government and its central bank to wean its economy off of greenback dependency. This forced detox from the dollar is the primary catalyst for the current analyst concern, because the intended consequence is to boost the usage and perceived strength of the Iraqi dinar domestically. But the unintended consequence, the one that keeps analysts awake at night, is the very real risk of creating a devastating dual economy. Think of it like this. As these new digital systems clamp down on corruption, smuggling, and dollar hoarding, the official, digitally tracked Iraqi dinar should, in theory, become stronger within the formal banking sector. This could lead to a stable, slightly appreciated official exchange rate that the world sees. But simultaneously, on the streets of Baghdad and in the informal markets, where cash dinar and cash dollar have always coexisted, a massive liquidity crunch could occur. If dollars become too scarce for everyday large-scale commerce, the value of the physical dinar in hand could actually plummet against the dollar in the black market, creating a catastrophic gap between the digital rate and the street rate. This is the analyst's nightmare scenario. A country with 2 wildly different exchange rates for its own currency, a situation that leads to social unrest, hyperinflation for basic goods, and a complete freeze on foreign investment. The mystery move, therefore, is this precarious tightrope walk the CBI is attempting, and the concern is that the very measures designed to strengthen the dinar could, in the short to medium term, trigger the exact opposite effect for the average person holding the currency, exposing them to a volatility they never anticipated. This is why the tone has shifted from hopeful waiting to cautious concern. So if the central bank's digital reforms are a double-edged sword, where else are analysts looking for clues, and what other data points are fueling this growing sense of professional unease? The answer lies not in Baghdad, but in the shifting sands of global energy politics and a specific, critical clause in Iraq's federal budget that has just been activated, a clause that most international dinar speculators have completely missed. For the last 2 decades, the value of the Iraqi dinar has been implicitly propped up by a single, powerful entity: the country's vast oil reserves. The economic model was simple and, frankly, fragile. Iraq sold oil in US dollars and used those dollars to create a currency auction, supplying the dinars needed for government operations and imports. This created an artificial, state-managed equilibrium. However, the new budget law, passed under immense pressure from the International Monetary Fund, contains a revolutionary and, for currency analysts, a terrifying provision. It legally authorizes the government to initiate pilot programs for selling Iraqi oil to specific, pre-approved trading partners not in US dollars, but in a basket of currencies that includes the Chinese yuan, the euro, and even direct barter agreements for infrastructure development. This is a geopolitical earthquake disguised as a fiscal policy update. The first of these pilot transactions, with a major Chinese energy conglomerate, was settled in yuan just last month, and the transaction data is publicly available in the shipping and trade finance portals if you know where to look. This move is a direct challenge to the petrodollar system that has underpinned global finance for 50 years, and while it may grant Iraq a new level of economic sovereignty in the long run, in the immediate future it introduces a seismic shock to the dinar's valuation mechanism. Think of the old system as a clear, predictable pipeline, oil in, dollars out, dinars funded. The new model is a messy, unpredictable web, oil in, a mix of currencies out, with each of those currencies having their own volatile relationship with the dollar. This fundamentally decouples the dinar's stability from the one thing that was always guaranteeing it, the unwavering demand for the US dollar. Now, the Central Bank of Iraq must manage reserves in multiple currencies, defending the dinar's value against the yuan's own fluctuations and the euro's regional pressures. This is an immense technical challenge for any central bank, let alone one operating in a post-conflict zone. The analyst concern here is about liquidity fragmentation. Instead of one large pool of dollar reserves, Iraq's financial strength is now being split into several smaller, less liquid pools. In a crisis, if the CBI needs to support the dinar, it may have to sell yuan or euro holdings to buy dollars, incurring exchange rate losses and transaction fees that further deplete its reserves. This complex maneuverability issue is why several reports from European financial stability think tanks have quietly downgraded the IQD's medium-term stability outlook from stable to negative watch. They aren't predicting a collapse. They are forecasting a period of extreme and unpredictable volatility as the system transitions from a single anchor to a multi-currency basket. This volatility is not the kind that leads to a sudden, dramatic revaluation. It is the kind that leads to wild, nerve-wracking swings in value that can wipe out savings and make rational economic planning impossible. This strategic pivot towards multi-currency oil sales is also the primary reason behind the sudden and noticeable divergence in analyst opinion. Those with a more traditional, dollar-centric view of the world are sounding the alarm bells, predicting a loss of American support and a dangerous isolation of the Iraqi economy. Meanwhile, a newer school of thought, often with stronger ties to Asian markets, views this as a painful but necessary birth pang for a truly independent Iraqi currency. The data, however, currently sides with the concerned. The forward rate agreements for the dinar, which are essentially contracts that predict its value 6 to 12 months from now, are showing a massive increase in implied volatility. This is a direct financial expression of the market's fear and uncertainty. The market is no longer betting on if the dinar will move, it is betting on how wildly it will swing, and that is a fundamentally different and far more dangerous game for the average investor to be in. The mystery is deepening from a domestic banking reform issue into a full-blown geopolitical recalibration, and the average person holding dinar is caught in the middle, holding an asset whose fundamental rules are being rewritten in real time. So we have a central bank forcing a digital transformation that risks creating a dual economy, and a government shifting its oil sales to new currencies, introducing unprecedented volatility. These are the storm clouds the analysts see gathering, but the final and most pressing question for anyone with a stake in this currency is a simple one. What happens now? Where is the point of no return, and what is the realistic endgame that the data suggests? The convergence of these two trends, the domestic cash crunch and the international currency fragmentation, creates a specific and predictable crisis point that is now being modeled by risk assessment firms. This crisis point is not a date for a revaluation, but a timeline for a liquidity event. The models, based on the current rate of digital adoption and the scheduled scaling of non-dollar oil sales, indicate that within the next 12 to 18 months, the Iraqi economy will hit a critical juncture where the demand for physical dollars in the informal market will drastically outstrip the supply being allowed in by the new regulations. When this happens, the street value of the dinar will likely plummet against the dollar, while the official bank rate may hold firm or even appreciate slightly due to government intervention. This widening gap is the trap. For an international holder of physical dinar banknotes, this scenario presents an almost impossible dilemma. Your paper dinar, the one you hold in your hand, will see its real, spendable value. Its purchasing power on the ground in Iraq erodes significantly. You may see a higher number on an official Forex website, but converting that number into a stable currency like the US dollar or euro at that favorable rate will become incredibly difficult, if not impossible, for a retail investor. The banks and official exchange channels will likely impose stringent limits, require proof of the currency's origin under the new digital tracking rules, or charge massive premiums to facilitate the trade. The analyst's sudden concern, therefore, is not that the dinar will become worthless, but that it is entering a period where its convertibility and utility for the average speculator will be severely compromised. The endgame predicted by this data is not a single life-changing event, but a protracted and messy process of economic realignment. The most probable outcome is a managed float of the official exchange rate by the Central Bank of Iraq, coupled with a painful but necessary devaluation of the physical currency in circulation to bring it in line with the street rate, effectively wiping out the savings of those who hope to bypass the formal system. This would be followed by the eventual introduction of a new, digital-first dinar, potentially even a central bank digital currency that would replace the old notes at a rate that solidifies the devaluation. This process would be framed as a successful monetary reform, a necessary step to combat corruption and stabilize the economy, and for Iraq's long-term future, it might very well be. But for the global community of dinar holders who invested in the old paradigm, it would represent a total and catastrophic failure of the revaluation dream. The information was always there, hidden in the technical reports, the budget line items, and the shifting patterns of global trade finance. The mystery move was never a secret path to immense wealth. It was the quiet unraveling of the very foundation that the speculation was built upon. The signals were all pointing towards complexity, risk, and sovereign financial management, not a simple, magical multiplication of value. The concerned analysts are the ones who have chosen to read these signals for what they are, rather than what they wish they could be. They see a nation undertaking the Herculean task of rebuilding its financial system from the ground up, a process that is inherently unstable and fraught with peril for passive spectators. The story of the Iraqi dinar is entering its most critical and volatile chapter, one defined not by hope, but by the harsh realities of economic physics and geopolitical ambition. And that is the full, unvarnished picture based on the data available right now. This is a fluid situation, and new developments can change this outlook overnight. If you found this deep dive valuable, if this original analysis has given you a perspective you haven't heard before, then you need to become part of this conversation. Do not make any financial decisions based on this video alone. Your most important move right now is to become your own analyst. Go and look at the sources for yourself. Search for the Central Bank of Iraq's financial stability reports, read the IMF's latest Article 4 consultation on Iraq, and look at the trade data from the platforms I mentioned. Verify this information. Smash that like button if this level of detail helped you, and subscribe to the channel if you want us to continue untangling these complex financial mysteries with the same data-driven approach. But most importantly, drop a comment down below and tell me what you think. Are you more or less concerned after hearing this analysis? What other data points are you looking at? This is not just about one currency. It's about understanding how the global financial machine works in real time. Let's keep the conversation going. Stay vigilant, stay informed, and I will see you in the next video.